You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Oh, it's been a busy day for Don McDonald Podcasts on this Friday when we're putting this thing together. I was on Stacking Benjamins today, and Tom just asked me, we were sitting around talking, he goes, so what did you talk about on Stacking Benjamins?
Yes, that's what I said.
That's what he said.
And I meant it. Yeah.
Well, what we did is on Stacking Benjamins every once in a while, they have a game show. And the game show pitted the round table, Paula Pant, Len Penzo, and myself against each other in a competition to see who could guess correctly the 10 habits for better investing from an article at M1 Finance. All right.
Now, what is M1 Finance? I'm not sure I even know.
Well, it's like a it's a money management platform. Paul Merriman used to use it. I don't know if he does anymore. You can set up goals and buy. I think you can even buy and sell. I think it has a brokerage component. Yeah.
Now, do you have an impact actually on? Do you have actual impact on monetary supply? Because isn't M1?
It's a different
some
M1.
Amount of money that's in the economy or something.
Yeah, totally different M1.
Okay.
It's a website.
Okay, just checking.
It's a website.
All right.
So anyway, there was this article. Apparently, no one was confident enough in it to claim that they authored this. So we sat around in the studio and guessed what was on the list. And I said things like, save regularly. Good habit, don't you think?
I think that's one of if you don't do that, you never get to be an investor because you got to save first.
Through the first 2 rounds, I believe, of the competition, not one of us got a single thing right.
Wait a minute. You all came up with guesses and you didn't. I'm questioning the whole bunch of you. If you can't get one of them, come on.
I know. At some point, I think I said out loud, I'm supposed to be an expert on this.
Yeah, that's a little scary.
It was. And then we started kidding around and saying, this list must be terrible. And I looked up the list. Are you ready?
Please give me a couple now. I'm dying to know.
These are the 10 habits.
10 habits
that will help make you a better investor. 1, educate yourself. All right. I'll give him that one.
The question is how, but okay.
Yeah.
I mean, would you watch Jim Cramer every day or read Investors Business Daily? Or
don't get me started on them.
All right, trying to make an easy one for you.
Yeah, they did say, fill in your knowledge gaps with resources like Jason Zweig's column.
Oh, okay.
Which
now
like.
There's one I can affirm. Yes.
I think I got that one because I came in close, but it wasn't exactly dead on. I think I got that one in a later round. We ended up in the lightning round to see who won. So anyway, that's the first one. The second one.
Yeah.
Again, I kind of agree with it, but I don't know that it's a habit of investors. Regulate your media intake.
That sounds like don't expose yourself too much to other people telling you what to do.
Yeah, I think they're talking about all the advice that you constantly hear on Investors Business Daily and CNBC and Fox Business and all of that stuff. So, yeah, okay. I'm going to kind of give you that. Shift your spending.
Okay, I have no idea what that has to do with being a habit of a better investor.
I don't either. It says shift your spending away from high-interest credit cards. That just makes you a better spender. That just makes you a smarter consumer.
Aspect.
Yeah.
Yeah, sure.
Nothing to do with investing.
No.
Sharpen your skills with automated investing. Now, what in the
Those
world?
are two different things. Because if you give all the money to Acorns and you let them do this automated, why do you have to sharpen your skills? Sharpen your skills when you go to Robinhood and you buy and sell options, correct?
Right. And this one, I think I understand why they put it on there and snuck it in the middle, because the third paragraph of the explanation says, on M1, we take automation seriously. See, I think it was a plug. All right. Number 5, study another long-term investor.
So this is
Hi, friend. Can I follow you around?
Well, yeah, I'm wondering. So, do you follow Warren Buffett into the men's room and try and overhear what he's saying to Charlie Munger in the next stall, or exactly how does this work? I mean,
At their age, you're going to have to spend a lot of time in the restroom because I'm sure it's taking plenty of time.
Ouch! There goes the afternoon. Yeah, I got it. Okay.
Yeah, I think that remember each investor has a unique strategy. No, actually, see, this is one of the things I find a little bit frustrating, I guess is the best word, about some of these publications and some of these writers, and is that there is an investing strategy that should differ from person to person.
Well, and the fact that there is a guru, and the fact that there is somebody out there who knows something that are going to whisper in your ear that's going to make you a better investor. We don't know that person, and we've been doing this for a very long time.
Next one is Clarify Your Finances. Now, I think that's just a really bad title for that one because the gist of it is pretty good. How much do you spend? We talk about this. How much do you spend? But that's a really terrible way of stating it. Clarify your finances.
Is that like making sure you understand how you're spending your money?
I think so. Yeah.
Okay. Yeah, I don't know what. Again, I don't know what the habits of investing, but okay.
I think. Len Penzo, if you listen to our podcast, you should have gotten one right because I think Joe messed up. It says, how much do you need to deduct from your paycheck to land on your employer's retirement match? And Len, you did say that. I'm giving you a point, Len.
Which is something everybody should know, obviously, because you want to get at least up the free money, right?
Right.
Yeah, and there's people overlook that all the time. See people, maxing it out. No, you're not even getting all the money they give you from your employer. The good people that work at Boeing leave, I forget how many millions of dollars on the table every year because they don't at least save up to the 6 to get the free money from Boeing. Crazy.
That's just silly. It's free money. Now, This one, again, badly phrased. Review your portfolio at regular intervals. Now, Len got this one given to him because he said rebalance.
So rebalance is good, but what I find though, if people review things often, then they have a tendency to say, I got to sell this because it hasn't done well and buy that because it has done well, which is the exact opposite of rebalancing. Rebalancing, you're selling the things that have gone up and buying the things that have gone down. It's counterintuitive. Most people who spend too much time looking at all this just end up making more moves and end up with less money.
Number 8, I don't even get. Turn your checklists into priority lists. I don't know that I
no
get that
idea
one.
What that means.
It says the problem with conventional checklists is that the check marks all look alike. So I guess you're supposed to say this check mark is more important than this check mark and put them in order.
Let's move on. Let's move on there.
You want another priority on your list?
I don't want that.
Okay.
I think it's a silly thing to say.
This one I got because I said,
good.
know your risk tolerance. And I was given this one by the judges. Number 9, master your emotions.
Which is, we already know, is the hardest part of all of this because we can show you how to build a portfolio. We can get you on the track. It's sadly, most people can't stay on it because stocks do this, bonds do this, whatever does this, gets in your head and you got to do something and it messes you up. You're right there. Good work.
And finally,
yes.
number 10,
Okay.
adopt a growth mindset.
So you're going to sell all your value stocks? You're going to only own growth stocks?
No. Here's what you have to do. You have to get into the growth zone. My portfolio is going to go up tomorrow. My portfolio is going to go up tomorrow.
Oh, okay. Because I've been in the growth zone since I was about 25, and I'd prefer to be the other direction, actually, if possible.
Value? Oh, not that direction.
I'm talking
Oh,
this growth right here.
You're talking. Oh, you stole Paul Merriman's joke again, or a variation on
a
the
diet
theme.
since the 4th grade. I have lost over 4,000 pounds. Thank you, Paul.
And again, this one has very little to do with investing. I get the growth mindset thing. You know, if you have.
But who isn't in a? I mean, I guess if you're 85 years old, you're not. But
Well, no,
otherwise,
I think
most
they're saying,
people are.
think about growing your career. Think that you're, for example, they used a quote. For 20 years, my research has, this is from Carol Dweck, who wrote a book on this. For 20 years, my research has shown that the view you adopt for yourself profoundly affects the way you lead your life. It can determine whether you become the person you want to be and whether you accomplish the things you value. But it has nothing to do with investing.
No, I actually, because I'm a believer in affirmations, I buy that.
Yeah.
Think and grow whatever, but nah.
And you believe the
Not in
sun
this
shines
case.
on your side of the street in Seattle all the time, too.
Yeah, I'm still waiting, by the way, for 2021 to kick in, if you don't mind. Where's that sun? Come on.
All right.
Yeah, it's coming soon.
Yeah, so if you want to hear the terrible game show, go to the Stacking Benjamins podcast for Friday.
When you tell me that,
26th.
I want to do the dating game theme, but I'm not going to.
Wasn't that a Herb Alpert thing?
Indeed, it was.
Let's do this one, Tom. I got a question for you. Quit humming and answer questions, darn it.
Yes. Okay, go.
Let me first thank you for answering my personal questions in the past and answering more through advice to others. I have been following, speaking of Paul Merriman's Fidelity recommendations for a few years. I was more tilted to small and value than his recommendations in a 95% equity, 5% bond allocation. Well, good for you. Then pay no attention to Paul. Now I am getting into my later 40s.
Okay, first of all, why 95-5? Why not 90-10 or 80-20?
I don't know. He's aggressive. It's okay. He's in his...
But 5% bonds, that is meaningless. Absolute. There's absolute.
Him feel
just be
better.
100. Go all the way.
He's in a growth mindset.
Finish the bottle of whatever you're drinking. Go crazy. It's Friday. I mean, come on.
All right. Now he's getting ancient, and he's in his later 40s.
Oh, yeah.
I just
really
added
old.
the
Okay.
ancient part.
Thank
and
you.
what I
Appreciate
consider a large amount invested, I am looking to move to an 80-20 or 70-30. His growth mindset is declining. I noticed the most recent recommendations Mr. Merriman is making: Fidelity Zero funds for a large cap blend, an international large cap blend. I would like your thoughts on these versus an actual index mutual fund. We'll start with that one, then I'll do the rest of the question.
Well, what do I think?
Yeah, what do you
I'd take
think?
the index fund every time.
I would too. And the fact of the matter is,
I'd have to talk to Paul as to why he's gone the other direction.
because
but
he
I would
sees
take
the
index
zero.
fund.
He sees the zero.
Like Coke Zero. They
Right.
can drink as much as you like and it won't kill you.
And
I mean,
the fact of the matter is the Fidelity Zero funds have zero expenses. But
I get that.
They're
I
not
get that.
identical to the entire index that the Fidelity index funds follow. And bear in mind, I believe the Fidelity U.S. index is a 0.03% expense ratio. Somebody's calling you, Tom. And that the Fidelity International, I think, is 0.06% expenses. So they're so low as to be practically non-existent.
well, and this is one of the, we want you to pay attention to expenses, no question. But sometimes the expense tail wags the dog a little bit here because I'm getting this free. Well, personally, I'd rather have an index fund. I know what I own. I know what it's going to look like tomorrow. Nobody's going to make some change there. So that's my take.
Well, and the Fidelity Zero funds aren't exactly the index. They try to
that's not my point.
look like the index, but they're not the index. So now he's also hoping to hear what we think of his bond positions. For a 70-30 split, his bonds would be 15% intermediate Treasury index, 9% short-term Treasury index, and 6% inflation-protected bond index. I was thinking splitting my bonds equally between the three. I know a lot of research has gone into his recommendations, but would like your take on this. And then there's one more thing after this.
Well, I think that's a good bond setup. Again, I would want this to be qualified money. Because if you're doing this in a taxable environment, you don't want to have the tips for sure, knowing nothing about your income and your tax situation. But no, I think that's a very reasonable amount. Remember that the short term and the tips, They're a little bit different, but not a lot. I mean, the thing you may get from the tips, especially now moving forward, is unexpected inflation on the horizon. Could really bail you out a little bit if we do get that.
Yeah, and I think that Paul's thinking, really, when you look at that, it's almost like a 50-50 split in the bond portion of the portfolio between the higher yielding intermediates and the almost non-yielding short-term and tips. So I think just go with it. But anyway, if you go 10-10-10, is it going to make a big difference in your life? No, it
won't. No.
All right, here we go. Last part of it. Lastly, I cannot remember you and Tom ever talking much about asset allocation. Huh? Really? I think we talk. Don't we talk about it? I guess we really don't a lot. I understand.
Okay.
I understand the tax benefits of tax-advantaged accounts, but even though I have an emergency fund of at least 6 months, I feel like all my worth is in retirement plans. I know if I start to increase money in taxable accounts, I would invest it so it would not be as reliable as the cash in my emergency fund, but I would have the money more available than the retirement accounts. Thanks for all you do.
I'm not sure I understand the question.
I do. I get it. He's
please.
saying over and above his retirement accounts, should he have a taxable brokerage account that's more aggressive than his emergency funds, but more accessible than his retirement accounts?
But accessible? I mean, I don't know.
More
what that means.
without having to pay taxes or penalties. Because he's saying right now, if he's pulling money out of his qualified account in his 40s, he's going to pay taxes and a penalty.
Okay, but if you put money into a taxable account and it goes up, then you pull it out, you're either going to pay long-term or short-term capital gains tax on that.
Plus income tax on
other.
Dividends.
Yeah, okay, that's going to be a small number, but yeah, it exists. So there really is no way to here's the only way I know of. The money in the taxable account, as he put it, the sort of post-tax, that's why I would not have bonds there, and I'd probably have all stock funds, obviously. Exchange traded funds are even more tax efficient, right, due to their treatment of capital gains. So that's probably how I'd look at it, to really max out what you're doing and pay the least amount of tax. Or
here's another idea. Again, once you've maxed all of your qualified accounts, I believe that you should max those if you can. Then you do the taxable brokerage account. But over and above that, if you've not completely maxed them out, it almost sounds like you're saying, should I have a 6-month truly safe emergency portfolio and then maybe 6 months or a year past that of secondary emergency? And that might not be terrible. To have 12 or 18 months worth of pseudo emergency money probably lets you sleep more soundly at night. So, yeah, what you might want to do for something like that is look at a balanced, a tax-advantaged balanced fund or something like that, tax-managed, if there is such a thing. I'd have to look. I don't remember if there are.
I don't know that there is tax-managed balanced index fund. You know, I mean, balanced index fund is fairly tax efficient anyway. In fact, because it's an index, they're not buying and selling a lot of the securities in the portfolio. They're not removing things around. So it's going to be pretty
Vanguard tax managed balanced fund Admiral.
There you go.
The symbol is VTMFX, and that could be your secondary emergency fund. And then as a tertiary emergency fund, you could use something even like VT or VT Wax. But I think that if you've not maxed out your other funds and you just want more money to be available without incurring a penalty, this may be the way to go.
I think that's a good idea. And again, here's something I would think hard on before I use a tax-managed fund of any kind. Truly what your tax rate is and what you're giving up in returns to own that.
Thank you very much for the question. And I think that pretty much wraps up this podcast. Remember, tomorrow, Saturday, well, see, it depends on when you listen to this podcast. On Saturdays, Tom and I do a live radio show that you can listen to live if you just go to talkingrealmoney.com. There's a player on the website, or we edit it down and turn it into a podcast the next week. So if you want to call us and actually speak with us live, Call between 3 and 5 Eastern Time or noon and 2 Pacific on Saturday to the same number, 855-935-TALK, 855-935-8255, or send questions in at talkingrealmoney.com on the contact form. And one more thing. If you have one of these convoluted questions, and we do get a lot of those, and sometimes we're just not able to answer them in the podcast because there are too many moving parts. It's just a lot of complication. We promise you that we, as a firm at Vestory, will help you at no cost, with no obligation and sales pitch, for a limited amount of time. We will not manage your money for free, but we will help you, and you won't feel like you're getting sold something. So if you really need some more involved help with your money,
you won't feel like it. You won't get sold anything. You won't feel like it.
But I mean, most of the time when people say that, you go, "Oh, God,
it's phony. It's a come on. Yeah. It's right. No, I get it.
It's not a come on.
None of that.
It's not.
Fair enough.
So go to Vestory.com, make an appointment right there on the website, or call our office at 800-386-3004, 800-386-3004. Thanks so much for listening to the Talking Real Money podcast. We do have a huge request, a huge ask. Tell other people about it. Spread the word. Put it on your Facebook page. Really. Tweet us. Tweet about us. If you're a tweeter or a Twitterer. Is it a tweeter or a Twitterer?
What if you're a tweener?
I haven't been a tweener in like 50 some odd years. No, I haven't been a tweener.
But what if you are? I don't know. Tweeter, Twitter, tweener. I don't know.
You could Twitter it. You can Instagram us. I don't care. I don't know what that is, but go ahead. TikTok us. I don't know what that is either, but go ahead.
Come on.
Or write a review. Silly. Well, what? Do you TikTok?
I've never, but I've seen TikToks. That's where that silly comedian used to be on. The now is her own TV show. She did the Trump things. And she was on TikTok.
You're right. So anyway, thanks for listening. Take care. We'll talk to you really soon. We're here all the time talking real money.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?